Thank you for joining me today. This series is called Financial Breakthrough with Aliya, and we are talking about credit in this episode. I spoke about it a little bit more in the last episode, and I just want to go into further detail in some specific parts that I found to be very, very important, and I want you to pass it on. All right, here we go. So, credit. These are the following things that I find to be the most looked at when you go to a lender to borrow money. Debt to income, and I'm going to go down the list and then I'm going to go into detail what they are. Debt to income, abbreviated as DTI. Credit score, revolving utilization, payment history, secured versus unsecured debt, and oldest trade line. So, the DTI is your debt to income ratio, and it's broken down just as simple as that. So how they calculate your debt to income ratio on your credit report is as such. So say you say your debt, so debt first. So say your debt is $1,000 a month. $1,000 a month, and you have, let's see, you bring in $4,000. 1,000 divided by 4,000 . 25%, because 1,000 is 1/4 of 4,000. So that was a pretty simple one. But say, for example, you have, so if that happened to you where you have a really high debt to income, you have really good credit, and you still didn't get the loan, this is why, because your debt to income was too high. Now next, credit score. That's really important. Sometimes lenders are very conservative and they say you have to have a certain score to lend from us. A lot of people do that, unfortunately, but sometimes there are wiggle rooms. Like I've seen people with 500s, 400s get certain types of loans, but some people really need you to be at a certain score to get a loan. So credit score is a factor. Revolving utilization. Back to revolving. Revolving is a line of credit that is revolving. It's a credit card. It's a line of credit. It's something that just keeps on going. You replenish it, you borrow, you pay it back. You borrow, you pay it back. You borrow, you pay it back. That's just how it goes. Revolving utilization. So if you have a credit card for $1,000, lenders don't want to see that you use the entire $1,000. They want to see that you have available revolving credit. That plays a factor. And that plays a factor when you're trying to get credit from lenders. They want to see that you're not maxing out your credit cards. There's that golden rule, that 30%. On any revolving line, you want to stay below 30%. Okay, that's the rule of thumb. Revolving line, that's a credit card or it's a line of credit. You want to, the difference between a line of credit is it's not attached to a card. It's used as cash, overdraft protection. Usually get them from banks or like home equities and stuff like that, but we'll get there. So revolving utilization, you want to make sure you're not maxing out your cards because lenders look at that. The second thing, let me see, 1, 2, 3, 4. The fourth thing is your payment history. Payment and your history. So you're looking at your payment history. Your payment history to make sure that you're not missing payments. Nobody wants to give someone money if they're not making payments. Right? If you're not making your payments, it's not going to look good to another lender. So they're looking to see when was the last time you missed a payment. And if your last time from missing a payment was last month, make that the last time. Because last month compared to 5 months from now will look really good on your credit report. So it's really easy to start building on that. So again, if you missed a payment last month, make that the last time, because a lender is going to see that last derogatory and say, oh, that was too soon. You just missed a payment. How can you be asking to borrow from me if you just missed the payment last month? So I'm telling you, remember I said 6 months in the last video. You want to apply for credit 6 months apart from each other. So if you missed the payment last month, the next time you should be applying for credit, if need be, 6 months from now, so that you can rebuild that payment history. So payment history is very important. They want to make sure you're making your payments on time and you're not late to other lenders. Then you have secured versus unsecured debt. That one isn't as important as these other ones, but the difference between secured and unsecured debt is secured debt is it's secured by something. So for instance, an auto loan has collateral, has the car is secured. Until the auto loan is paid off, the bank owns that car. Unsecured debt is stuff like credit cards, revolving lines, stuff that they can't take from you. So you want to have a good ratio between unsecured and secured debt. And then the last but not least is oldest trade line. So established credit is very important. It's harder to get credit when you have no credit, which is mind-blowing to me. But when you have no credit, it's hard to get credit from specific lenders, from good lenders. Conservative lenders. So the oldest trade line. So I hear people all the time, they say, oh, I'm going to pay my card off and I'm going to close it. If that's your only card, I would not recommend you closing it. How about you pay it off and you shred the card? Keep the line open so that it can continue to build a good payment history. You don't have to use it for it to be on your credit report and showing that you have a zero balance, especially if it's a credit card. You have a zero balance and you've maintained great payment history because you're not using it. So if anything, it just develops your character of your credit score and it helps you for your benefit. Alrighty, those were my tips. My name is Aliya. It's been a pleasure. If this video was a blessing to you in any way, I ask you please to share, like, subscribe, and I cannot wait to be with you next time. Thank you for joining me. Financial Breakthrough 2020. We got this. It's going down. Bye.